Tools for financial analysis. In this chapter number 3.1 deals with three aspects: comparative financial statements, common size financial statements, and trend analysis. Let me finish up the illustrations first, then you will understand the theory automatically. There will not be any complications. It's one of the easiest chapters. We'll try to finish off faster. So, common size statement. From the following income statement, prepare a common size statement and also interpret the results. Okay, common size. Clear? Common size is nothing but converting the data with a common number, probably percentage, that's all. How can you represent the candidate is doing well? Okay, very simple. The performance of a candidate can be easily found out by showing his results in percentage. Okay, some students may get 40 marks, some students may get 60 marks, some students may get 70 marks. But the out of how much is the trouble? Is that okay? So 40 out of 60, 70 out of 100, 60 out of 80, 35 out of 75. Now among the four number, which is the best one? Then this is a complication. You can convert everything into percentage, then comparing may be easy. So make all the results into a common size, means convert that into percentage, which is called common size. Convert that income statement or balance sheet, whatever it may be, in a percentage angle. That's all. Rest of things will be over. In this case, sales is assumed to be 100. Sales is assumed to be 100. Now from this it is very clear. For the year 21-22, 1000 is assumed to be 100. What about the rest? 300 is assumed to be 30%. 200 represents as 20%, 10%, 60% is the overall manufacturing cost. And GP being 40%. And other operating cost being 15%, so net operating cost being 25%. This is what about the results in year 1. Usually it represents everything in terms of percentage. So the cost divided by sales into 100. That's how you can calculate all these things. Material cost divided by sales, labor cost divided by sales, conversion cost divided by sales, and GP divided by sales total. That's all. That's how we will get this answer. For 22-23, 1500 is assumed to be 100. Then what about 120? 120 divided by 1500 into 100. Come on, tell me. Hope 28%. This is 21%, 12%, and overall manufacturing cost being 61%, and your GP being 39%, and 300 for 1500 being the other operating cost, other is 20%, and your net profit being 19%. So you have to compare why the net profit percentage is decreasing compared to the previous year. Previous year net profit, operating profit being 25%. In this year, we have only 19%. The reason due to increase in manufacturing cost. Last year it is 60, now it is 61%. 1% extra spent for the manufacturing, and 5% extra spent for the other operating cost. Because of these two reasons, our operating profit to your sales will be decreasing. But ultimate total value or total operating profit may be increasing, but relative term shows decrease in the operating profit ratio. Similarly, in case of 23-24, 2000 is assumed to be 100, then 620, 31, 18, 11, half only, no. 2000, half of that 100. Similarly, cut 0 and make the half, you will get the answer directly. In this case, 60. What's the value here? 1150, 57.5, and here 40. I think there is some error. This is 1200, I think so. Okay, the total being 1200. Then this is 60, 40, and 18, 18 and 19, and finally it's 21%. After converting that into percentage, you can easily compare the values. Among the 3 years, which year gives us more profit, and in terms of cost, in which year we spend more, all these things can be easily found out. This is called common size. Common size P&L account. Similarly, in case of common size balance sheet, total assets or liabilities is considered as 100, and out of that 100, each and every component could be certain percentage. You have to calculate that. That's all. It's very simple. Shall I move on to the next one? See, requires no additional working. Learn, that's all. Not more than that. You can go straight away to the exams. You don't need to worry about these concepts. Now, common size balance sheet. Common size balance sheet. Okay. Under common size balance sheet, prepare common size statement. Okay, you can prepare. We have been given the shareholders' funds and current liabilities, non-current liabilities, and current assets. So common size means you have to make everything into percentage form. Where in income statement the sales is 100, rest will be certain percentage, and the sales will be there, so you can calculate. In case of balance sheet, the total is considered as 100. Total is considered as 100. Okay. If 10,000 is 100, 1,500 should be 15%, 15%, 20%, and 50%. In case of non-current assets, out of 10,000, bank being 1,500 or 15%, debtors 20%, inventory 25%, non-current assets 40%. Calculate the same way for the next year. Out of 12,000 rupees, 5,000 is the equity share capital, and what is the proportion here, or percentage here? 5,000 divided by 12,000. 41.67%, 25%, 15%, and 18.33%. Similarly, in case of assets, 12,000 and non-current assets being 6,000, otherwise 50% and 25%. Here 16.67% and 8.33%. Hope you will be able to understand common size. Only one point to be noted here. Common size means make of every element into the percentage form. Where in income statement, sales is assumed to be 100, rest will be calculated certain percentage on the sales. In case of balance sheet, the total is assumed to be 100, rest will be calculated certain percentage of the total value. Clear? Now, so common size over, let's move on to the comparative. Comparative is what? Compare with the previous year's results. Comparing with the previous year's result, what about the today's or this year's result? Is it increasing or decreasing? Stating that increase and decrease as a information in additional column, that's what about comparative statement. Let's see. Comparative statement of income statement. First of all, income statement is given here. Yeah. Yes, come on. What about the increase or decrease here? Is it increase or decrease? Sales 1000 becomes 1500, so 500 increase. 300 becomes 420, 120 increase. 200 becomes 315, 115 increases. Okay. And 100 becomes 180, 80 increases. Right. Actually, in the text, I have made slight correction. This is being 415, this is being 80. Okay. I made this change to have increase and decrease both the values. So 200 to 415, There's an increase of 215, 100 becomes 80 means 20 decrease. I put the value in brackets for decreased item. The ultimate value being 315 increase in respect of sales, cost of material, labor and conversion cost. GP increases by 185, other operating expenses also increases by 150, and overall net profit increases by 35. Is that okay? In the text, I have changed this to have the different field. Rather than this 100 is changed into 100. So 300 is converted into 100. You make these changes. Sum is very simple. But to get the increase and decrease value, I have made slight change in the numbers. Then ultimate value being 485 profit. So in case of other operating expenses, 50 rupees decrease is there, and ultimately the change in profit being 235. 235. Not only that, next one being you can represent that the same increase and decrease in percentage also. In percentage also. Compared to the previous year, what is the change? 500 increases from the previous year balance or value. 500 increases from the previous year. So the value is calculated this way. Increase or decrease in the value compared to the previous year, and previous year value represent that in percentage. If you want to state this as a percentage. From 1000 it becomes 1500 means 500 increases from the base value of 1000 means 50% increases there. Next year 120 increases from the base 300, 40% increases. The next one being 215 increases from the base 200, 107.5%. Then 20 decreases from the base 100, so 20% decrease in negative. Your profit change being 315 is the increase from the base 100, 600. Then, come on, tell me, 52.5% actually increases. In case of GP, 185 increases from the base 400. So this will be 46.25%. And operating expenses, it's now 50 decreases from 150. So naturally 33.33% decreased compared to the previous year's operating expenses. Finally, operating profit 235 increases from the earlier year's base 250. Then 94% increases there. Hope you will be now able to understand the comparative. Common size means make all the values into percentage, where the sales and total assets and liabilities is equal to 100. Rest will be calculated the same ratio. Comparative means based on the previous year's information, what could be the change in the current year. You can represent in terms of absolute number, also represent in terms of percentage of change. Percentage of change. Is that clear? Income statement is over. Now we will move on to the balance sheet also. Balance sheet also. Okay. Now, comparative statement for the balance sheet. Come on, tell me, what about the change in the assets and liabilities? For the equity share capital, no change. For the resource and surplus, 1000 increases. For non-current liabilities, 300 increases. And for the current liabilities, I can make slight change here. This is converted into 1000. This is 3000. Okay, to make the sum at least to have a meaningful approach. So 1000 becomes 500 means 500 decrease. 1000 becomes 1500, 1500 increase. Ultimately 2000 increase. Here 2000 increase, 500 increase, 0 change, 500 increase, 500 decrease. Sorry. The overall value being 2000 increase. Now next one being increase or decrease percentage. How will you calculate this? Increase or decrease in amount divided by previous year details represent in percentage. So change being 1000 and previous year details 5000, so it becomes 0. Next one being 1000 increases from the previous year balance 2000. 1000 and previous balance 2000, so 50 percentage. Similarly, 500 by 1500, 33.33 percentage, and 1500 also 1500, 100 percentage. And 2000 increases from the base 10,000, 20% change. Here 2000 from 4000, 50% increases. 500 from 2500, 20% increases. 0, 0. 500 decreases. Here this 33.33 is minus value. 500 from 1500, 33.33 percentage decreases, negative value. Finally 2000 from existing 10,000, it's nothing but 20% increase. 20% increase. Is that clear? So we have completed common size as well as comparative statements. Next one being trend ratio. Shall I move on to that? Trend ratio. Trend analysis or trend ratio analysis. Like you might have studied in capital gains, the indexation number. In 2001, we assumed the value being 100, thereafter slightly increasing the value, 109, like, okay, 116. Similarly, the base year will consider the value being 100. Year on year, the change will be now, based on the base year, you have to find out the new one. So among the three, the base year being 21, 22, no. In 21, 22, all the values are considered as 100 only. That's a value here. 100. Clear? In 22, 23, 1000 becomes 1500. Then 100 becomes how much? 1000 is assumed to be 1100 means 1500 should be, you can do the cross multiplication. So 1500 divided by 1000 into 100. 150. So your sales in 2021 1000 becomes 150 by the end of next year. Okay. Similarly, what about the 22, 23? 2000 from the base 1000, which is the base year. 21, 22 is the base year. The number in the year in which you are going to calculate it divided by the base year's value in the denominator. You can represent that in percentage. Then there should be 200. 300 is 100 means 420 should be 140. And 315. 200 is 100 means 315 should be 157.5. Am I right? 100 is equal to 100 means 180 should be 180. 600 is equal to 100 means 915 should be 915 divided by 600 into 100, 152.5. And 585 divided by 400 into 100, 146.25. Very simple. 22, 23 value in numerator, 21, 22 value in denominator represent in percentage. And in this case, 23, 24 numerator, 21, 22 denominator being always the base year being 21, 22. And here 150, 100 means 300 should be 200, and 250, 100 means 285 should be 285 divided by 250 into 100, 114. Am I right? And for the year 23-24, 300 is equal to 100 means 620 should be 620 divided by 300 into 100, 206.67. Similarly, 360 by 200, 180, 220 divided by 100, 191.67. Sorry, 220, yeah, okay, sorry, this remains 220. 1150 divided by 600, 191.67. 800 divided by 400, 200, and 380 divided by 150, 253.33, and 420 divided by 250, 168. Hope you'll be now able to understand this one. Now, so three content are there in first chapter: comparative, common size, and trend analysis. In case of common size, financial statements restructures financial data to display each item as a percentage of a common base. Usually the common base may be sales or total assets or liabilities. In case of balance sheet, we'll take the total asset is equal to 100. And in case of income statement items, that sales is considered as 100. Comparative financial statements is prepared by recasting financial data to compare the elements, each and every elements of financial condition from year to year in both absolute terms and percentage. Absolute means directly comparing the differences in the value. Trend analysis compares the financial items across periods using index numbers like, okay, cost of inflation index, right? So you can take the base year value being 100 and the change is now reflected by keeping the base year's value. Okay, for any year, that year's value should be in the numerator and the base year's value should be the denominator, you multiply it with 100. That's how we can calculate the index. Trend percentage focuses major items, highlighting significant changes from a chosen base year. Typically, the earliest or intervening year. Usually, earliest year will be taken. So here, the earliest year being, okay, 21-22. From this year, you can now easily see sales grew almost 2 times. And conversion cost grew more than 2 times, and operating cost also grew more than 2.5 times. That's how you get the idea about the trend of each and every element of your financial reports. Based on that, you can decide whether which component can be reduced or controlled so that ultimate capital means profit could be increased. So with that, 3.1 chapter is over. And ratio analysis 3.2 was already completed. We'll now move on to the financial scores. Financial scores. Okay. In financial scores, we need to understand 3 scores: Z, M, and F scores. Altman's Z score, Beneish M-score, Piotroski F scores. These are the 3 scores you have to understand. Okay. So especially this Altman Z score, that will give the a hint whether the company is capable of running for the long period or supposed to be liquidated or insolvency. Moving towards insolvency or that company is financially strong for long life. We'll now focus Altman's Z score model here. In Altman's Z score model, financial items are grouped into 5 aspects. 5 aspects. Altman's Z score. Is that okay? You have no other option. You have to mug up this. Come on, tell me. Working capital by total assets. Why do we use this ratio? Working capital divided by total assets. Liquidity. Retained earnings by total assets. Retained earnings by total assets. Ability for reinvestment. How much of your income is reinvested? That is called reinvestment. So this is what about reinvestment. EBIT by total assets. Profitability. When you are considering the profit, then it's a profitability. And when you are taking the liabilities in your capital structure, what is that? Leverage. And sales by total assets, turnover ratios. Turnover ratio is nothing but activity ratio. How actively it is generating the income. Our firm's ability to generate the income. Is that okay? Now tell me, a company gives you good return, but may not work for a longer period. The next year it may be collapsed. Will you be happy to invest in that company? Some company will not collapse. Huge capital structure and planned capital is also there. There is no any hiccup, but no profit at all. Will you invest there? What's there to invest in that company? Okay, huge investment is there. Also, profit is also there, but the profit is relatively lower. Sales is not growing compared to the previous year. This year sales is just meagerly 0.1% higher or lesser. Sales remains constant. Your assets grew up faster year on year. You are pouring the money, but the sales remains same, or your profit remains same. You are not unhappy. You are not happy now. So especially Altman now designs a simple formula. Keeping all the 5 elements for his study to decide whether the company is really a stronger company for the long life or not. Will not go for liquidation. If you think this company, as per the Altman's Z-score model, is viable for a long life, then you are safely investing that. You're supposed to invest in a company. That company gives you 50% return. Happy. In banks, you'll get only 5 or 6% interest. This company gives you 50% interest. So you'll be happy to invest in that. The moment you invest the next year, the company collapsed. Right? Your entire money has gone. You got 50%, but your capital has lost. So before investing, you have to be careful with what? Whether the company will have the long life or not. Is that okay? For deciding whether the company will have long life or not, we can simply depend on Altman's Z-score. It's a multivariate model. Okay, multivariate model means it compares all the aspects. I invest based on only the profitability of the company. Then it's a single variate, univariate. My only intention is to get the profit. Okay, you'll get the profit. The company collapsed. Oh my God, I have not seen that. So what do you have to do? We have to care about the profit, care about the long life, care about the proper mixture of the capital for growth. So we need to consider all this aspect now. So profit is not only my motto. The existence of the company without liquidation is also my motto. In that case, I need to consider all the 5 aspects. So here 5 aspects are there. Multivariate model, or this is a model to calculate car trade distress prediction. Distress is nothing but stress or restless. Suppose the company is going to be closed. Here, you have to find out 5 values. One is liquidity. Another one is power of reinvestment. Another one is company's profitability. Another one is whether there is a leverage or means debt component or not. Finally, okay, self-generating ability. Is the company capable of generating good income or not? Also, this is also profitability. This is also profitability. This is purely profitability. This is nothing but overall turnover. So we have to consider all the 5 aspects first of all. Then after Z assigns the values for liquidity I'll give 1.2 times weightage. That's how altman now gives the weightage. And in case of reinvestment, 1.4 times weightage. In case of profitability, 3.3 will be the weightage. Okay, you have to find out the value. You have to find out the value for x1, x2, x3, and x4, x5. Okay, x4 and x5. Is that clear? Now, for the leverage, the weightage being 0.6. For the self-generating ability of their investment, one weightage will be given. One weightage will be given. Is that clear? Now, using this, you have to find out the value. That value is named as Z. That value is named as Z. Clear? Thereafter, if the Z value is more than 2.99, the final Z value, what you calculated, you know, if it is more than 2.99, you are safer. This company is not going to be closed or liquidated or insolvent in due course. So, you will be very safer to invest in that company. Clear? So, here this list is given. So, after the calculation, you have to use this table to decide. Okay, what's that table? What's the table? The final Z value, what you calculate, you know, less than 181, then the company is supposed to be liquidated or insolvent faster. And if the Z value is anywhere between 1.81 to 2.99, maybe non-failed or failed. It's a slight doubt. If the company's Z value is more than 2.99, non-failed or non-distressed firm means it will not be liquidated or insolvent, it will have the long life. So here, in case of Altman Z-score model, you know, you have to compare the 5 aspects. What are they? Liquidity, reinvestment, profitability, leverages, and self-generation ability of their investment made in the form of sales growth. After calculating all this value, you now assign a weightage for each and every aspects, weightage. So my predominant weightage goes to my profitability. So 3.3 weightage is given for that one. 3.3 times. Is that okay? Profitability 3.3. And reinvestment second weightage 1.4. And liquidity 1.2. And income generation 1. And leverage is very lesser impact. So 0.6. That's how the weightage is given. No other way. You have to mug up this number. 1.2, 1.4, 3.3, 0.6 and 1. You have to mug up this number. Is that clear? This is the number framed by Altman. Okay. Now, let's see. From the information given below relating to bad past, calculate Altman's Z-score. So this question is all about a bad past limited. So bad, this company had bad in the past. Currently, this company is recovering. Nicely named. Nicely named. Clear? So let's try to find out the Z-score for this company. 5 numbers are there. 5 numbers. Can we calculate one after one here? Working capital to total assets. What's the value? 0.25. Retained earnings to total assets 30%. 0.3. Profitability, EBIT by total assets 0.15. Market value of equity to liabilities, leverage, equity to debt to 150, 1.5. Sales to total assets being 2 times. So we got this value. Now you have to multiply with this Z values. 1.2 into 0.25. How much is that? 1.2 into 0.25, 0.3 and this one 0.3 into 1.4, 0.42, and here 0.15 into 3.33, 0.495, 1.5 into 0.6, 0.9, 2 into 1 to get me the total of this value 4.115. This is the Z value. Z value in this case being 4.115. As Z value being 4.115, naturally this falls under the first case. So automatically this company has no distress, non-failed. It is not going to be failed in due course or non-distressed company. Okay, that's how you can name this Z score, Altman Z score. I used this particular score for my doctorate study. My entire doctorate study, you know, I took around 10 steel companies for my study. For all the 10 companies, I used the ratios only predominantly. All the ratios are grouped in these 5 heads. These 5 heads. Especially in case of liquidity, the question in this case is working capital by total assets, you know. I used all the ratios for the liquidity first. And then I took the average and assigned 1.2 times for that. Similarly, I assigned the value such a way for all the 10 companies and found some of the companies may be distressed. Profitable, some of the companies are distressed. As per my study, by the time Tata Steel, JSW, Salem Steel ranked topper in my study, okay, in 2006 and 7. So then the price of Tata company share was around 600, 620 like, and later on now it crossed more than that. It's more than 1,000 rupees now. I think it is currently 140. I think after the share split, 110 rupee share is converted into 10 1 rupee shares. If you want to invest in the stock market, you can apply all these things, Altman Z score also. But usually it's a rare one for my real stock investment purpose. I need to have the other ratios that we have studied, ratios for investors angle like EPS, PE, dividend yield ratio, market value, book value ratio, even Gordon's growth model, those models, and how much of the income earned is reinvested for the growth, and that will have the impact on growth, you know. So I usually follow those ratios rather than Altman, because Altman requires calculations. I cannot keep on calculating this for all the 10, 100 or 200 companies I go for analyzing a day. Okay, it's not practically possible for me. Yeah, of course, you can feed all this detail in Excel sheet. That Excel sheet will give the details easily. You can calculate very easily, right? So anyhow, Altman is one of the beautiful ratios. Usually I miss to watch. Because of that reason, I lost 2 companies' investment. Profitable company, but went for liquidation. Profitable company went for liquidation. 3 superb ratios are here. Altman and Piotroski. Another one is Beneish. These are the 3 famous ratios. I thought to use that in my practical life, but I have not used. Without using this also itself, okay, I can make good money. So if you are able to use this, then you can use it for a longer term, okay, and larger investment if you want. Okay, you can also practically apply this Altman. So Altman considers 5 elements. That's why it's called multivariate. Don't always cross verify with the revenue, profit and sales. Profit increases, the sales price of the share also increases. Or profit decreases, the price decreases. Then it's called univariate. Price of the share increases or decreases due to not only the profit, it may be due to the leverages and dividend and liquidity, as well as other factors. N number of other things are there for determining the share price. So give the importance for all the 5 aspects is the suggestion given by Altman. Clear? Now Altman has a revision. This is the first basic model recommended by Altman. Again, Altman has revised his own suggestion. The revision is given here. Okay. What's that? Let's see here now. Revision. This one is Z-score, augment Z-score model for manufacturers, industrials, and non-manufacturers in emerging markets. Emerging markets. It's a new market. Okay. In that scenario, Z-score is totally different. Okay. Let me finish up this one also. This is only a formula. Okay. This is only a formula. So, liquidity, reinvestment ability, profitability, financial leverage. What is not compared? Sales to the total assets not compared because it's an emerging market. Now only the market is going to be picked up. We don't have such a market earlier. Okay, it's an emerging market. Because of the emerging market, the last one, the sales and total assets particular variant is not taken. This aspect is not taken here. Clear? Let's see. As per the emerging market, Z-score suggests only 4 aspects, and X1 is nothing but what? Working capital by total assets. Like working capital is current assets minus current liabilities, retained earnings by total assets, and EBIT by total assets, equity by total liabilities. Everything is similar to the earlier one, but the number weightage assigned is totally different. Okay, the weightage assigned here being totally different. Okay, you remove this, it's a wrong. Okay, this one being 4. Hope now you'll be able to understand that. You can correct this. Now 6.56 is the weightage given for X1, means liquidity. 3.26 is the weightage given for the reinvestment for X2. 6.72 for X3, which is nothing but profitability. In case of leverage, 1.05 is the weightage given. Clear? After that, if you calculate that Z value is more than 2.6, then this company is safer. Less than 1.1 is distress zone. If it is in between, then it's a gray zone. May happen to be distress or safe zone also later on. Clear? That's all. So I request you mug up the first aspect here. Here all the things you have to mug up, no other way. I usually think, why do they ask this question for the examination? Seems to be foolish to be added in the syllabus. Because anyhow you are not going to use it for your practical life. But the number, memorizing the number also foolish like. Okay, which is not practically possible. I thought such a question may not be expected in examination, but I referred the previous year's question paper and found in one examination they have asked similar questions. No other way you have to mug up. But safely what you can do, you can mug up the basic one, this one. The improved Z score model not required to be mugged up. Similarly, in Beneish also we have to mug up. Beneish also we have to mug up. This is a second model. Okay, in Beneish. Clear? Beneish and Piotroski. Okay. I think you may not get the practical questions in your examination for the Beneish M-score, but anyhow we'll see. But the Piotroski, the last one, Piotroski, the investors are still using it. This model is used. Piotroski F-score model. Okay. Now, screener.in. How many of you are aware about this site, screener.in? Huh? you know. Then you have attended share class. Okay. So others, you can go and create an account for analyzing the companies. Okay. I log in using my existing Google credentials. Now here you can create a screens. You can create a screen. Okay. The logic of creating the screen is nothing but choosing the companies. There are thousands of companies, 10,000, 15,000 companies are there. Let's see how many listed companies are there. How many listed companies in India, especially NSE? Yeah. Total companies being this one. 2084 companies are listed currently. Okay. 2000 companies. How can I analyze all the 2000 companies? So then I want to pick based on what? Already told you, know. What's that? Investors based ratios. What are the ratios you need to know? P ratio. Okay. Not only that, I need to know dividend yield ratio and book price to book value ratio and what more ratio? Growth, sales growth or profit growth. P ratio should be how much? Should be less than 10. Dividend yield should be at least more than 1%, very lesser number, 1%, because dividend yield is very lesser. Book value, price to book value should not be more than 4, so less than 4. You can give the conditions also. Sales growth should be more than 10%. Run this query. You got all the companies as per our search. Right. So National Aluminium, P ratio 7, dividend yield is 4.81. We have given dividend yield should be more than 1% or 2% something. What's the number we have given? Okay, we got this. And the price to book value should be less than 4. That's how I gave the number. And PEG should be, I have not given, but they have taken this one also. And growth, ROC and profit growth, everything is given here. You got how many companies are there? 28 companies as per our conditions. You no need to take all the 2000 companies details to analyze, only this one. Choose these number of companies and decide whether this is suitable or not. Right. Now edit the columns. I can now again change the screens. Can I give Piotroski? Here is the Piotroski. I am going to teach the third score to decide whether company is good or not. Okay. And I can give one more, promoters holding. Promoters holding. The Piotroski score should be okay, should be there. The promoters holding should be more than 40% at least. Now with this detail, let me get other details. Piotroski score should be more than 5. Here I don't have. I can include. What's that? Here is. I now include this one. Yeah. Now we got what? Piotroski score also. So you can include these are the ratios for your requirement, and based on these ratios you can very easily decide which company is performing better or not. This financial management is one of the beautiful chapter where all the study what you have learned here can be used in screener like software or somewhere you get the answer easily. Now dividend yield should be higher and P should be lower. So you can click this way. It will now start posting the lowest PE onwards. And Piotroski should be higher number. So I click this. Now it is arranged in descending and ascending order once. So now it is a descending order. If it is 9, this is a strong company. JK Bank and National Aluminium being strong company. The maximum score that we can get in Piotroski being 9. 9 factors are going to be taken. If all the 9 factors are favorable, give 1 mark each. Then after that, if you sum, then you will get the 9. If some factors not suitable, make it 0. So automatically you get less than 9. Okay. So Piotroski. Okay. And before I go for the Beneish model, let me finish up the Piotroski model first of all. Under Piotroski model, 9 elements are there. What are they? Profitability criteria, leverage, liquidity and source of fund criteria, operating efficiency criteria. 3 predominant criteria. Among the 3 criteria, we are going to consider 9 elements. If that particular element is favorable, give 1 point, else 0 point. If all the 9 elements are favorable, then you will be getting definitely 9 points. The maximum Piotroski point you will get being only 9. If it is 9, then the company is safer and profitable. That's what about the Piotroski F-score suggests you here to decide whether the company is doing well or not. Let me now go for return on asset and change of return on assets, change of cash flows and change of accruals. The return on asset is nothing but total assets being 1 lakh and your profit being 10,000 means 10%. If the return on asset is positive, give 1 point. And you need to compare the return on assets, okay, with the current year and last year. Okay. So this represents change. If ROI compared to the previous year, this year is higher, then it is called positive. And cash flow, change of cash flow compared to the previous year. Previous operating cash flow being 1 lakh, this year 1.1 lakh. So the change being 0.1 lakh positive. Previous year 1 lakh, in this year 0.9 lakhs. So here the change is 0.1 negative. Isn't it? If it is positive, give 1 mark. If it is negative, 0 mark. So compared to the what? Previous year, positive return on asset in the current year. Positive. If the return of asset is positive compared to the previous year, give 1 point. Return on asset is positive in the current year. So asset being 100 and return being 10, then automatically 10% it is positive. 5 rupees loss for your asset of 100 means minus 5%. Then you have to give 0 point. Here you have to give 1 point. Previous year 10%, in this year 10.5%. Compared to the previous year, there is a change positively, then give 1 point. Is that okay? Similarly, operating cash flow in the current year is compared with the previous year. If the change is higher or positive, then give 1 point. And cash flow from operations being greater than net income of the current year. Find out the net income and cash flow from operations you calculate. If the cash flow from operation is greater, see, cash from operation is 100 rupees, net profit is say 80 rupees, then this is greater, give 1 mark. Otherwise, if the cash from operation is 80, net profit is 100, then what happens here? Give 0 mark. A company, actually I invested after a long time. I stopped investing in the stock market. After a long time, I started investing in the stock market. That company's EPS being almost 18 rupees. Market price per share is just 20 rupees. EPS is 18. Market price is how much? Just 20. It means if you invest 20 rupees, the very first year itself, that company gives you earning per share rupees 18. Matter of 2 or 3 years later, after the amount what you have invested is returned, still you have bulk money. I tempted to invest. The P ratio also lower, profitability is also very, very higher. Every year's profit itself almost closer to my share price. I purchased. Matter of 6 months, that company corrupt and went bankrupt. I get no money. Suddenly got totally confused. Then I went for analyzing the company's cash flow statement. Came to know their main cash flow, is only from cash from financing. It's a cheating. Anyhow, we will be studying the cash flow statement and fund flow statement in the subsequent class. I'll give a small hint here. Okay, business gets the cash. Okay, the cash what the business gets can be classifiable into 3 categories. Whether due to the operation, due to the financing or investing. Okay, these are the 3 reasons. So if you are getting the cash from investing, what does it mean? You are selling the asset. If you are getting the cash from financing, it's nothing but borrowing. Okay, so this company had around 100 rupees cash. I thought that company is really doing well. Later on, I realized the cash is due to this reason being 60, this reason being 70, but due to the operation 30 negative. But the net profit, it's around 50 rupees. This company has net profit, but cash from operation is 30. What does it mean? What does it mean? In your P&L account, your net profit is 50. Your net profit is 50. Clear? Now, the reverse of depreciation, what is it? Revaluation profit. Revaluation profit being almost 80 rupees. Because of the revaluation of your assets, asset value is increasing, but you don't get the cash. Am I right? So you showed a profit of rupees 50, but the profit of 50 is not due to the business operation. You purposefully inflated your assets value. Reverse of depreciation. By inflating, asset value is increasing. That increased value is considered as profit and shown in the P&L accounts credit side. And inflating your loss, reducing the loss and making it profit. If you don't show this, definitely you'll face loss. Is that okay? See, this is 30 rupees is the operating expenses. 80 minus 30, 50. Actually, correct one is you should not show this one. If you don't show this, operating expenses becomes your net loss. Am I right? So, I missed to see what? The company's cash generating power. Is it due to the operation or some other reason? If the company can generate the cash due to the business operation, do lots of sales and get the cash. Do lots of sales, even though collection is made. Then you get the cash due to the operation. If the company gets the cash only due to the operations predominantly, then the company is stronger. Don't consider the net profit. Some company is making good net profit, but will not have any cash. So I made that mistake. This particular company's cash from operation is negative and net profit is 50. They have manipulated the numbers that made me to invest and lose the money in the company. Thereafter, whenever I started investing, immediately go and see whether they get the profit due to the cash from operation or some other reason. Similarly here, cash flow from operation should be greater than net profit. Here net income is 680 and cash flow may be lesser. This 80 is not cash. Understand? Anyhow, once you understand the cash flow statement, you will be able to understand this logic also. Hope now you will be able to understand all the things here. All the 4 aspects is for considering the profitability. And in case of leverage, liquidity, source of fund. Leverage, you know that. What is that leverage? Long-term debt. If the long-term debt is lower amount, compared to the previous year. Last year, the debt being 1 crore, now it is only 90 lakhs. Happy. Liquidity, current ratio. Compared to the current ratio of the previous year, this year's current ratio is higher, then you will be safer. And equity, source of funds. No new shares were issued in the last year. Okay. So we don't have any fresh issue in the previous year. Only the existing equity shares are there, then we are positive. So these are the three things: leverage, liquidity, source of fund. And finally, operating efficiency. Operating efficiency is nothing but profitability as well as turnover. Higher gross margin compared to the previous year. Last year GP is 20%, in this year GP is 20.5%, then 1 point will be given. Asset turnover ratio, last year 1, this year 1.5, then yeah, of course this year is better. So these are the 9 elements are going to be studied. For each and every positive aspect you give 1 mark, and if you sum you'll get 9 maximum. Okay, if it is not favorable then give 0 mark. Definitely the value should be anywhere between 0 to 9. So one is profitability criteria, ROA, and change in ROA, change in cash flow, change in accrual. And leverage, liquidity, equity shares, margin and turnover. So these are the 9 factors are there in Piotroski. Interpretation. F score should be 8 or 9 so that it will be good value company. And if the Z score is anywhere between 0 to 2, it is considered weak company, don't invest here. So you see all the other ratios. Apart from that, if you are using the Piotroski, okay, if the value is anywhere between 8 and 9 or even 7 also tolerable, acceptable. But if it is 0 to 2, 1 or 2, be careful, don't invest there. Piotroski's investment strategy in 3 steps. I'll just give that in 3 steps. Book to market. Calculate book to market for all the firms at fiscal year end. Categorizes values into quantiles. Okay. Then use the F score. Calculate F score for all the firms in the highest quintile at fiscal year. And investment by the firm 5 months after fiscal year end, sell 12 months after the investment. So this is how we can plan. Okay. Now book value to market price. You have to calculate this one first of all for all firms. Okay. And categorize that into quintiles. Okay. So you might have heard about the percentile and all. What is called percentile? You know that percentage. But when it is cut off mark for all the MBBS exams and all, no? Percentile, decile. Percentile means all the students, maybe around 1 lakh students are writing for NEET exams. Assume. Okay. Their entire mark will be now grouped into 100. 1, 2, 3, 4, 99 and 100. Okay. Now, how many students got the mark in this group? This is called percentile. 100%. Okay. 100%. Quintiles. I think quintiles may be 5. I think. Okay. 5 or 4. Okay. Let's see. Quintiles. Now, five equal values. Okay. All the companies what you calculated book to market, you block that into 5. 1, 2, 3, 4 and 5. Okay. You group all these companies into 5. Okay. And calculate the F score for all the firms in the highest quantile at fiscal year. You have to consider this one only. For this only you can calculate the F score. Top 5 best companies. It's not only 5 companies. You have 2000 companies, For all the 2000 companies, you use the book to market value and rank them. Out of that, the first 20% companies, top 20% companies that's coming under here. Okay, 20% company. This is 21 to 40% companies. This is 41 to 60% companies, 61 to 80% companies, 81 to 100% companies. You forget about all these companies, those things are unfit. The best 20% companies are chosen. For this, you can use a F score. Buy the firm 5 months after fiscal year end, sell 12 months after investment. So fiscal year ends on 31st March 2025. 5 months after means, okay, 31st August 2025. After that, you purchase. 12 months after, you can sell so that you can get some profit. That's how strategy is given for the Piotroski. Okay, list all the companies book to market value and arrange that in a descending order. After that, 20% company only be chosen. For all the 20% companies, you use the Piotroski. Using the Piotroski ranking, you can choose some companies to be purchased when after the fiscal year, 5 months after that, hold it for 1 year, then you try to sell, you will get good profit. Okay, only for the education purpose, don't try. Anything happens to you because of this trying, don't blame me. Clear? This is what about the strategy given by the Piotroski. So the last one is Beneish model. Okay, we'll see that now. Let's see Beneish M-score model. This one is to measure whether the company has manipulated its earning or not. Probably a company shows you that this company generates huge profit. So you mainly depend on the profit shown by the company and start investing that. If the company manipulated the earnings, it's a wrong one. Then the dependability on earnings is not actually valid one, so you may miss your investments. You have to be double cautious. So before you rely on the investments profitability shown by the company for your even investment decision, you have to be careful whether the earnings is shown properly or is there any manipulation. For that, actually a model developed by the students from Cornell University, and they simply found out a new score called M-score. Okay, so they use this M-score for verifying whether the earnings is correctly shown or manipulated for n number of companies, and surprisingly they found the Enron Corporation's earnings is manipulated. As per their study, they stated that Enron Corporation is not showing their profitability correctly. It's a big scam. Enron Corporation showed a big scam, right? Let's see. ChatGPT will see Enron company. Okay, scam in notes form. Okay, we'll see. Short notes form. Enron company. So another famous case study. Enron Corporation, Houston, Texas, USA, industry, energy, commodity services. Scam period being 1990 to 2001. Accounting loopholes, special purpose entities to hide the debt and inflate profit. They have inflated the profit. False revenues, mark to market accounting manipulated, and executives sold personal shares at high price while encouraging employees and investors to buy. They inflated the sale price also and inducing the employees to buy the shares at the higher price. And the key people involving here being Kenneth Lay, Jeffrey and all. Exposure in 2001, and stock collapsed from $90 to $1, and bankruptcy also filed. Entire $90. Okay, everything is collapsed. By the time it was around 35 rupees, I think so, per dollar. For 3,500 rupees worth of share becomes zero because of their manipulation. Thousands lost jobs, pensions, shareholders lost billion, collapse of Arthur Andersen, Okay, one of big 5 accounting firms who are involving this manipulation also collapsed. Okay, auditor Arthur Anderson. An Enron scam is equal to corporate fraud using false accounting, debt hiding, massive collapse leads to reform US financial laws also. So one of the beautiful case study for reforming the financial aspects. This particular Beneish M-score, they use this. See, you can take any numbers. Okay, so what are the primary numbers I will consider for investing means always P ratio and dividend yield ratio. That company's profitability earning ratio should be lower, P ratio, not profitability. Price earning ratio should be lowest, and PEG should also be lowest. And then I consider one more aspect, dividend yield. That company should give the dividend decent. These are the 3 predominant factors I'll start with to go for further study of the company. You can have your own logics. A number of ratios are there. No, you can take 1 or 2 ratios as your charming ratios. Okay, based on that ratios, you can decide whether this company is suitable or not. Similarly, you can take around a set of 20 ratios and group all the 20 ratios to give importance for some ratios and least importance for some other ratios to decide whether the company is good or not. Usually, I will consider around 20 ratios. But immediately if you ask me what are the 3 ratios or 2 ratios, I straight away go for the dividend yield and P ratios. Apart from that also, I compare another 10 to 15 ratios by default to decide whether the company is suitable for my investment or not. Okay, and those other factors are least important. I'll give less weightage. Similarly, Beneish also have taken n number of ratios and giving weightage for that, like Z score. So here, almost 8 things are there. What are they? One is DSRI, Days Sales and Receivables Index. Another one is GMI, Asset Quality Index, Sales Growth Index. Like this, almost 8 factors are there. 8 factors. Okay, hope now will be you are able to see all the 8 here. Days Sales Receivable Index, number 1. Okay, usually sales 100 rupees and receivables, average receivables being 10. Okay, this is the previous year detail. Current year detail, the sales being 110, average receivables being 10.5. Then how will you calculate DSRI? If these details given, net revisable receivables are receivables for the current year divided by sales of the current year multiplied by sales of the previous year divided by receivables of the previous year. What's the ultimate value you would be getting here? $0.95. Is that okay? 0.95. This is called Day Sales and Receivables Index. Similarly, Gross Margin Index. Okay, Gross Margin Index. Okay, so sales being 100, so GP being, I can use the GP here. GP being 20 rupees, here 25 rupees. Then how can you calculate? Okay. GP of the previous year divided by sales of the previous year. Sales of the current year 110, GP of the current year 25. What's the ultimate value you are getting? 0.88. That's how we can calculate all. Of course, not required to mug up all these things. Not required. I have not seen any illustration. Also not available any illustration in your text. But I have given here a simple formula like so that you can understand this. Days Sales and Receivables Index is equal to net receivables by sales into sales by net receivables. T represents current year, T minus 1 represents 1 year earlier to this. GP index, GP by sales and inverse of sales by GP, current year information and previous year information, sales growth index, sales of the current year divided by sales of the previous year, depreciation index, okay, depreciation index, asset value being 100, depreciation being 10, am I right? Assumed to be previous year, current year, asset value being 120, depreciation being 15. How can you calculate? Depreciation of the previous year 10 divided by overall assets value of the previous year into current year assets value divided by depreciation value. That's how we will get this answer. This is nothing but depreciation. This is nothing but asset value. Asset value usually closing property, plant, equipment plus depreciation, means asset value before depreciation. Asset value before depreciation. Hope you will be now able to understand this. PPE plus depreciation. PPE is nothing but depreciated value of the assets, block, property, plant, equipment. So with that, if you add the depreciation, you will be getting the assets value before depreciation. And sales general administrative expenses, SGAI. Now you have to compare these sales general administrative expenses with the sales. That's what about the sixth one. Leverage index. Leverage index. Okay. Current liabilities divided by plus total long-term debt, or total liabilities in numerator divided by total assets. That's what about the leverage index. Okay. CL represents current liabilities, LTD represents long-term debt, and total accruals to total assets. Total accruals to total assets. Accrual means outstandings. Income from continuing the operations minus cash from the operations. Okay. That's what about the accruals. So accruals is nothing but income from continuing operation is nothing but sales is 1000. But cash from continuing operation being 600. What does it mean? Sales may be in credit term, and this is nothing but collection from the debtors. Balance 400 remains debtors. So the amount recoverable from the debtors is called accruals. That 400 is considered as what? Current liability, current assets. That's what about the accruals, outstanding income. So that's how you can understand all these things. And finally, asset quality index. Asset quality index. Okay. Now, total assets in the numerator, current assets, property, plant, equipment, and the amount invested in securities. All the three will be taken, and this entire value is subtracted from 1. So we have these 8 factors here for the calculation of Beneish. Okay. So all the 8 factors are now calculated, used for calculating M-score with the weightage. So you start with minus 4.84. With that, you have to multiply 0.92 with the DSRI, 0.528 into GMI, and 0.404 into AQI, 0.892 with HGI, and 0.115 with the DEPI, and minus 0.172 into HGAI, and this is how we can calculate all these things. If the ultimate value what you get is the M-score, if the M-score is anywhere between or less than minus 1.78, okay, then it is not manipulated, they are not cheated. If the value is more than minus 1.78, and it's a manipulated. This is as per CMA material. When I refer the website, this number is totally different, it's minus 2.22. If the value of M being less than or equivalent to minus 2.22, then it's not a manipulator. If the value is more than minus 2.22, then it's a manipulator. They have manipulated. You have to be double cautious. Don't rely about the profitability shown by their company. You need to understand the theoretical angle only. I don't think so. The same questions may be asked in your examination to calculate. So there is no any illustrations in this topic in your text. So I have not shown any illustration. But Z-score, I have been given some basic illustrations also in the past year's question paper as well as the instruct material. Remember that here only a logic. Only a logic. And apart from that, now here are some errors. Beneish model. We have the errors, type 1, type 2 error. Okay, type 1 error and type 2 error. So we have the chance to get errors also. If the M-score is greater than minus 1.49, the relative error cost being type 1 error being 10:1 with respect to type 1 to type 2. that you no need to worry about that. So we have two types of errors in case of statistical analysis. At your research period, you will study. But for the CMA level, more than enough, more than enough. See, let me explain what is called type 1 error and type 2 error. Okay, sometimes if one more question is asked, you need to answer, right? So you think minus 2.22 and the value is less than this. Less than this. Okay, what does it mean? This is considered as non-manipulator. Non-manipulator. If the value is more than minus 2.22, then it is a manipulator. As per the M-score, Beneish M-score, the value what you get is less than or equal to minus 2.22. We may assume this is being the non-manipulator. They are not cheated. If the value is more than minus 2.22, it may be considered as manipulator. Is that clear? Manipulator, non-manipulator. Clear? But is there any chance of error? We assumed this is a non-manipulator. Okay, but actually this fellow is manipulating. Say company A is a manipulator. As per the Beneish model, we came to know it's a non-manipulator company. Okay. Classifying a firm that is manipulating actually as a non-manipulator is called type 1 error. And classifying a firm as a manipulator when it is actually was not manipulating. The second company is actually non-manipulator. Non-manipulator is a good company. Because of the Beneish model, we came to know he may be a manipulator. Also error. A manipulator wrongly classified as a non-manipulator is the error type 1, and a non-manipulator is classified as a manipulator is the error type 2. After all, it's a statistics only, no. By using the statistical technique, we get not exact answer. It will give some answer, but there is a chance of error. We used the Beneish M model and we found using that number 2.22 or as per the CMA material, it's 1.78, whatever it may be. You found out the number. As per the number, you classify this being the non-manipulator. Who knows, it may be manipulator. Being the manipulator, because of the M-score, you classify this as a non-manipulator, then type 1 error. The company originally non-manipulator, but we classified him as a manipulator due to the application of Beneish M model, then it is called type 2 error. Hope you will be now able to understand. So, best cutoff point depends on the cost mistakenly classifying. Let's say again cost. Type 1 error. Classifying a firm that is manipulating earnings as a non-manipulator. Classifying a firm as a manipulator when it actually was not manipulating. Okay, hope you will be now able to understand. And last one is Piotroski F-score. Joseph Piotroski, Chicago accounting professor, has introduced this one. 9 aspects are based on the accounting results over a number of years. A point is awarded each time standard is met. A point. Okay. A company has a score of 8 or 9 is considered good value. So we have completed all the scores here. So what are the 3 scores we have studied? Z-score, Beneish M and Piotroski F. In Z-score, we have the improved one also for the emerging market. Emerging market, we have considered only 4 groups. Beneish, we have 8 aspects covered. In case of Piotroski F, we have considered 9 aspects, where 8 and 9 is the best companies, right? Or anything, anywhere more than 5 or 6 also advisable. More than 5 or 6 also advisable. Clear? Hope now you'll be able to understand the scores used here for analyzing the company. We'll move on to the next content, risk and return. Now, everybody's intention is to reduce the risk and increase the return. Okay, you need to have a mixture where the reduced risk should give you most return. Such a way you have to choose the investments. Before we go understanding the related theory, let me try to finish up this illustration. Question number 1 here. Okay. Question number 1. Yes. Consider the data of 4 shares for 2 years, the base year and year T. This is base year, this is year T. Number of shares held given here. Okay. Now, what is the overall price at the 0th period of 4 companies put together? 4 company shares are there, their price at 0th period is given here. The same 4 companies share price by the end of 1 year is also given here. Currently the value being 195. Matter of 1 year later, for all the 4 companies put together, the value is 235. 235. Now tell me, what is the value change? 235 is the today's value compared to the earlier day's value being 195 in terms of percentage. 121. I can round up this to 121. Clear? So if you have 100 rupees at the 0th period, it may grow up to 121 by the end of first year. This is what about the price weighted index. Price weighted index. And we have the equal weighted index. Equal weighted index is nothing but like a trend. The investment in A, B, C, D, in the very first instant, you assume that you invested 1 share in A, 1 share in B, 1 share in C, 1 share in D at the 0th period. By the end of first year, the 1 share each invested in A, B, C, D, as per the first year ends value is 235. It means for 100 rupees of your investment, today you have 121 rupees. Next question, no sir, I am investing 100 rupees in A, 100 rupees in B, 100 rupees in C, 100 rupees in D. Okay, it is not 1 share. 100 rupees in A, 100 rupees in B, 100 rupees in C, 100 rupees in D. I have invested 400 rupees. Okay, so 2 aspects are there. Give me 400 rupees, I will invest 100 rupees each for 4 shares. Or you can say buy 1 share each in all the 4 shares. Buy 1 share each in all the 4 shares is price weighted index. I give 400 rupees, buy equal amount in all the 4 shares. If I purchase for 100 rupees shares in A, what could be today's value? The price 40 becomes 30. Then if you purchase for 100, your amount may be 75 only. Cross multiply that. 40 rupees becomes 30 rupees means 100 rupees should be how much? 30 by 40. Otherwise, price T divided by price 0 into 100 rupees you invested. You will get only 75 rupees. 30 by 40 into 100. The same if you invest 100 rupees in B, how much will you have? 60 becomes 65 means 100 becomes 125 and 20 becomes 40, then 100 becomes 200 rupees. You are very happy with investing in C. Your money got doubled. But in case of C, 75 becomes 90, but you invested 100 rupees. Then 100 rupees into 90 by 75, 120. Your 400 rupees now will be available as 520. Okay, 520. So 520 is the today's value you have for the 400 rupees of investment, and ultimate growth in this case being 130. This is called equal weight index. Equal weight index. This is called equal weight index. Is that clear? Now, more logical way is nothing but based on the value. What is the value of the shares in A? 40 is the share price of A, how many shares are there? 3. Then value of these companies share at 0th period is nothing but price at the 0th period into number of shares. 40 into 3 lakhs, 120 lakhs. And 60 into 12, 720 lakhs. And 20 into 6, 120 lakhs. And it becomes 75 into 5, 375 lakhs. What is the overall company's entire value in the market? You add up all the three. 1335 lakhs. Now, value by the end of first year, price by the end of first year is multiplied with the number of shares. So, here 30 into 3, 90 lakhs. And 75 into 12 lakh shares, 900. And 40 into 6, 240. And 90 into 5, 450 lakhs. What is the ultimate value? 1680 lakhs. Now, based on the value, today's value compared to the yesterday's value, find out the growth here. So, 1680 lakhs is the today's value compared to the yesterday's value being 1335 lakhs in percentage. The ultimate value being 126. This is called value weighted index. Value weighted index. Hope you will be now able to understand this one. Price value index, weighted index, equal weighted index, and value weighted index. So, what is the use of this, sir? This one is the method followed by Indian stock markets for determining Sensex as well as Nifty. Sensex and Nifty. Is that clear? That Sensex is nothing but sensitivity index of 30 companies. So you choose the best top 30 companies using the market capitalization, arrange it under descending order. After arranging all the listed companies, right, in BSE, Bombay Stock Exchange, based on the market value, arrange that in the descending order. Take the first 30 companies. That 30 companies value, when? In 1971. In 1971, these 30 companies value of 30 companies in 1971, okay, is equal to 100. Today, the 30 companies value in 2025 is around 82,000 points. See how many times it grew up now? 820 times. If your dad has 1 lakh rupees in 1971, it could be now how much? 1 lakh into 820 lakhs. Otherwise, how much? 8 crores 20 lakhs. Isn't it? 8 crore 20 lakhs? Yes. 820 times it's grew up. In case of Nifty, Nifty, it is nothing but national 50. The top national level top 50 companies are taken for this index calculation. The first letter of national and leaving the first letter of 50 coined as their index number. Value weighted index. Value weighted index for the 50 companies is followed by Nifty. In 1995, 50 companies value is considered as 1000, and in 2025, the value of these 50 companies shares being around 22,000 traded today. 22 times grown. 22 times. No, okay, 22 times growing. Clear? So now you'll just see the importance. Now if I ask you a question, is that stock market growing or cheating or losing? All the myth is there, right? Some may be favoring, some may be totally adverse. The stock market seems to be cheating. Remember, without stock market, no country will grow. No country will grow. Okay, where do you want to get placed? Do you want to be placed in a small, probably petty shops after completion of your CA, CMA? Or do you want to get placed yourself in a big company like Amazon and Wipro as a CFO? Where do you want to get the jobs? Petty shops are there. If you want to get a job in a big company is started with the money from where? General public. For mobilizing the fund from the general public, we need to have the stock market. Without stock market, the companies cannot be started. Cannot be started. So a nation's growth is determined based on the company's strong market scenario. Market should available there. But of course, small companies also, small trade business, petty shops, opened and closed now and then. Similarly, big company also opened and closed now and then. You have to be double cautious where to invest. The 30 companies in 1971 are the base for the Sensex calculation. In 1971 are not the same in 2025. Some companies will go out from the 30 companies, and some companies may come as a new company within the means list. So in India, we follow value weighted index for determining the index. Securities market and market index calculation. Securities market for equity, debt, derivatives. How will we calculate the indices? So we have the price weighted index, equal weighted index, and value weighted index. Usually in India, we follow what method? Value weighted index, Sensex and Nifty, sensitivity index, and national 50 stocks. Let's see. We'll now search. Okay. What are the companies listed or taken for Sensex calculation? Sensex calculation. So you'll now get the list of Sensex as of mid 2025. How many companies are there in Sensex? 30 companies. See, these are the 30 companies. If you ask the question, okay, list the 30 companies from 1972 to today. Is there any change? Any change in the companies? Okay. 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 My fingering is this much only. Okay. Let's see. The Sensex was introduced on 1st January 1986, but its base year is 1978. I was wrongly told you it's 71. It's not 71. 78 and 79 with the base value being 100. In 70, I think it is only 71. Let me cross check. I think here 1972. I'm correct. I'll ask her. Base year could be 1971 or 1972. This fellow gave me the wrong answer, I think. Let's see. Not 1971. Those years when BSC already had trading activity, but Sensex index did not exist. Okay. Exist, but index introduced only in this year. Okay. Anyhow, good. Now, what are the companies are there? Here. I'll change. Yes. So So this one is beautiful. You can play with chat gpt, and today we have n number of other AI also thinking longer for better answer. Oh, I don't want that. So Reliant Communication introduced a joint replaced Sun Pharma in 2011. Reliance Infra replaced by Coal India. Okay, these two are Anil Ambani company got bankrupt and moved out, and Sun Pharma and Coal India came. Tata Power replaced by Lupin. Hindalco replaced by Asian Paints. BHL, Power Grid Corporation, Gale. So these companies not static company. These companies are moving always, right? Now let's see parameters for choosing Sensex companies. Sensex index companies. Let's see. Oh, okay. Here it's thinking no. I had to delete that. Yeah. This will not work. It's thinking. We'll go fresh. Okay. Listing trading history. The company must be listed. Listing history for 6 months and predominantly market capitalization. Market capitalization is nothing but number of shares the company issued and current market price. You multiply these two. That's called market capital. The company must be among the top ranked by free float market capitalization. Okay. Then liquidity, turnover, daily turnover, industry, financial performance, reputation, compliances. We have to consider all the factors. Free float market cap, liquidity, sector representation, listing history, governance, all these things will be taken. So based on that, these 30 companies and 50 companies are chosen. Some investors, being very cautious to invest blindly, they will just choose the companies listed already in Nifty and Sensex, because those 30 companies and 50 companies are scrutinized being the top company based on so many analysis. No, why do I want to then bother about applying other factors for deciding whether this company is good or not? So we'll directly go investing there. There are some people. So investment strategy is totally different. Hope now you'll be able to understand how we can calculate the Nifty and Sensex in India. One of the most favorable method is value weighted index, which is nothing but market capitalization. Is that okay? Even if you go and study further, these details are still given in more elaborated way also, but of course in your examination not required those things. Only this idea is more than enough. Hope now you'll be able to understand the question number 1 here. What method we follow in India? Value weighted index method. Value weighted index method. Now, let's see some practical questions here. Yeah. Come on, tell me. Following are the price and other details. Following are the price and other details of 3 stocks for the year 2021. Calculate the total return and return relative. Come on, tell me. What is the return for stock A? Beginning price being 30, ending price being 34, and this share gave you dividend rupees 3.4 during the period. Come on, tell me, what is the return? Hmm? You are getting how much? 24 percentage, 24.7 percentage. Am I right? 30 rupees you invested becomes 34. Then you'll be getting 4 rupees capital appreciation. Apart from that, you'll get 3.4 dividend. So overall growth. So this is revenue return. The difference between capital beginning price and ending price is the capital return, capital profit. So capital gain will be attracted for the profit earned, the difference between ending price and beginning price. Dividend is the regular income. Anyhow, both will be your income only. How can you calculate? Price by the end of first year minus price at the 0th period. Don't forget to add the other dividend revenue, divided by price at the 0th period. If you represent that in percentage, this is called total return. Total return. You invested 30 rupees, you got 3 rupees 40 paise, and the 30 rupees becomes 34 rupees. 4 rupees is your capital profit, 3 rupees 40 paise is your revenue profit, your investment at 0th period being 30. If you represent that in percentage, it is 24.7%. Very simple. Logically, you can understand. Similarly, for the B, 72 becomes 69, so you lose 3 rupees. 4 rupees 70 paise is the dividend revenue. Revenue return 4.7, capital loss 3 rupees, 1.7 is the your return for 72. Then the ultimate value being 2.4%. Am I right? Then 140 becomes 146, 6 rupees gain and another 4 rupees 80 paise. 10 rupees 80 paise is the gain for 140. Then what's the final value? 7.7 percentage. This is called total return. Now, whenever I talk about return relative, okay, always add another 100% extra, otherwise 124.7. Or you can name this being 1.247. This way also you can represent. And in this case being 102.4 percentage or 1.024. Here 107.7 percentage or 1.077. Return relative is nothing but I invested today 100 rupees. By the end of first year, it become 107. Then what about this value? Final value 1.07. It means the 1 rupee becomes 1 rupee 7 paise. Like this is called return relative. Relative term. You have to understand the two differences. Total return is only considering the return is called total return. What the amount invested, how much it could be by the end of first year or the period end. If you compare that way, this is called a return relative. 100 rupees becomes 107. 7% is the total return. 100 becomes 107 means 1.07 times grown up. Then it is called a return relative. Hope you will be now able to understand the total return and return relative. Clear? If it is clear, text me. We will move on to the next one. Now I will move on to the next one. Now, we try to solve this illustration. find out during the past 5 years, the returns of stock were as follows. What to be found out here? Arithmetic mean, variance and standard deviation. Three things are going to be calculated. I'll explain cumulative wealth index and geometric mean later on. That's very rare for your examination purpose. For the complete analysis purpose, we need to understand these three. Mean, standard deviation. Standard deviation square is the variances. Right. See, if you want to invest in companies, certain companies' shares, what do you do usually? You need to cross verify whether this company is generating good profit or not. How will you know whether the company is generating good profit or not? It is not comparing the profitability of the company for the immediate previous year. You will see past few years, around 5 to 6 years, you just go and see all the previous year's record. And based on that, you will decide that this company will be generating good, strong profit in the coming days also. It means an approximate average returns earned by this company for the past 5 to 10 years. If a company gives you constantly around 10 to 12% return for the past 10 years, you will be very happy this company is a stable company, gives a decent income of 10 to 12%. You will have more confidence in investing in that. First of all, you need to, before you go for investing a company, first of all, you need to check whether the company gives you a constant return over the period. That's called average profit. Now, the next one is deviation. So, we have two companies, company A and B. Company A and B. Company A gives you 10% profit and average. Company B also gives 10% average. As company A also gives 10% average, company B is also giving 10% average. Now, the question is in which company you want to invest? In which company you want to invest? Sir, how can I decide, sir? Both the companies are giving me the same 10% return. Now, you just go and check. What about the fluctuation of this profit in the previous year? Company A has 2% deviation in the previous year. It means sometimes the profit will go to 8%, sometimes it may go 12%. But in case of company B, 8% standard deviation. Sometimes you will get only 2%, sometimes you will get 18%. If I ask you, I have two mode of coaching. Two mode of coaching. For one mode, the coaching fees is 10,000 rupees. For another mode, it is 50,000 rupees. Okay. Now tell me, which mode do you want to join? Here, in 10,000, you have the chance to score All India Topper also. AR, All India Topper also. Okay. So, here, All India Topper also, if everything goes nice. Otherwise, you get less than 10 marks. Here, you score anywhere between 200 to 210 only guaranteed. If I ask you, are you not interested to score All India ranking? And your fees is also very less, sir. Just to pay 10,000 rupees, you have the chance to score All India rank also. The next question, what is the probability that I will score All India rank? Around 5% there is a chance. 95% you have the chance to score only 10. What about the other one, sir? See, 100% you will score anywhere between 200 to 210. Which course do you want to choose? This one or this one? Sir, you can charge even 5 lakhs rupees, sir. I will choose this one. So, it's not big money matters. It's what about the static standard without variation money matters for me. So, first of all, I had to find out the static return earnability of the company, which is called mean. From the mean, there should not be so much deviation. That's my second criteria. If the deviation is higher, then it's called riskier. This is riskier, but profitable. This is less riskier, low profitable. But anyhow, I'm pretty happy with this one, not this one, sir. So, we have to check whether this company gives you constant return based on the average profit. Next one is there any deviation? In that case, the deviation should be lesser to invest in that company. That's the logic. So, we need to calculate mean as well as standard deviation. Let's see now. For the calculation of mean, it's only average, right? So, year 1, 2, 3, 4, 5. Now what about the return? The return can be assumed to be X here. So 7%, I can convert that into percentage. 7%, 3%, and minus 9%, 6%, and 10%. So the summation of X being 17, and what about the return average mean? Divide this by summation of X by N is called mean. So 7 by 5, 3.4%. So you are getting an average of 3.4% return in your business since very long ago. Now I have to find out the standard deviation. For the standard deviation, the formula being x minus x bar or mean to the power 2, take the summation and divided by n minus 1 or simply n. Okay. Simply n, and finally take the root of this. So I have to find out the x minus x bar first of all, and then take the square of that. So is 7 minus 3.4, 3.6, here minus 0.4, minus 12.4, 2.6, 6.6. Now find out x minus x bar to the power 2, this value being 12.96 and 0.16, 153.76, 6.76, 43.56. Then overall total in this case being 217.2, and 217.2 is the x minus x bar to the power 2 and summation divided by n being 5, and take the root of this. Come on, get me the value. N minus 1, in case n minus 1, 4. You divide this by 4 and take the root of this. Okay, 7.4%. Okay. For the calculation of standard deviation in denominator, you can use the n minus 1 formula or sometimes n formula also, no problem here. You can use one of the two formulae. And variance is nothing but square of that. Okay. Come on, find out the variance here. Standard deviation square is equal to variance. I think 54.3% or 217.2 by 4. 54.3. If you take the variance, root of variance, then it's called standard deviation. So the mean is 3.4. It may vary plus or minus 7.4. So 3.4 plus 7.4 means it's almost 11%. In worst scenario, 3.4 minus 7.4, you will face loss also. So it's how you can make the decision. So your expected return in this business is 3.4, may go up to another 7.4 in addition to that, or weaker by another 7.4. This is what about the standard deviation. So if the customer demands, will I make any loss, sir? My investment should be returned safer. Even small money is okay. I don't expect more. Then you have to suggest, even after the negative deviation, it should not be negative return. Okay, negative return. That's how you can make the decision here. Hope you will be now able to understand. Clear? Cumulative wealth index and geometric mean, these two are pretty rare, and you will just try to understand that. Okay, here I have given the formula. Under cumulative wealth index, okay, now you have to multiply all these things rather than what's that relative return. What is the relative return for the first year return? You have to add 1, right? 1.07. Second year 1.03. Third year 0.91. Fourth year 1.06. Fifth year 1.1. If you multiply all these things, what is the value you are getting? 1.17. This is called cumulative wealth index. This is called cumulative wealth index. Now, this is relative return, no? Otherwise, you can show this as 17%. 17%. Sometimes we may use the cumulative wealth index also, but geometric mean is very rare. Anyhow, you cannot calculate this also without scientific calculator. You can simply skip. Okay. This cumulative wealth index, is similar to compound amount like. Okay. Especially geometric mean. Let's see. In case of geometric mean, it is similar to compound amount, not cumulative geometric mean. In this case, the value what you calculate here, you have to take the fifth root. Okay. 1.07, 1.03, 0.91, 1.06 into 1.1. Take the nth root. Here the number of years here being 5. So you have to take the fifth root, which is 3.2%. Clear? Between the cumulative wealth index and geometric mean, if I ask you, which is the best one, sir? As per the cumulative wealth index, this company gives you 17% return like. But as per the geometric mean, you get only 3.2%. If you are interested to invest in a investment scheme that gives you at least a 10% return, as per the geometric mean, you don't choose this because it gives you only 3.2%. But in case of cumulative wealth index, you thought it gives you 17%, so you decent to invest in this business. These two methods, cumulative wealth index as well as geometric mean, both are confusing you. One shows you that you are earning only 3.2% like, another shows you almost a 17% return like. Then between these two, which should be chosen? You have to choose the geometric mean. But practically, we are not going to use it. But there is a logic behind this. Geometric mean is similar to cumulative rate of interest. Okay, we have already studied time value of money, right? Simple interest, cumulative or compound interest. This will be similar to compound interest. See here, I'll just use the Excel sheet here. Okay, but of course it's for understanding purpose only, very rare for your examination. Now what happens? Year 1, 2, 3, 4, 5 years are there. What's the return in the year 1? 7%. Otherwise 1.07. Second year 1.03. Third year, hope it is now able to read. Then 0.91, 1.06, 1.1. Clear? If you have 100 rupees invested here, by the end of first year, how much you will have as per the cumulative interest? 107. Next year, 3% return will be there on that. The next year, This is how the change happens year on year. So you'll be getting how much? 17% being your return. I'll make 2 decimals. Yeah. 100 rupees becomes 116.94. Otherwise, 17% is your return. For how many years? For the 5 years. That is called cumulative wealth index. But as per geometric mean, your answer is only 3.2. Am I right? 3.2. Only 3.2. Okay. So 3.2 means every year you are getting 1.032. Okay. Every year you are getting only 1.032. If I invest 100 rupees here, how much this will be by the end of first year? Repeat this. It's almost 109.9. It's almost 109.9. Okay. This is what about the small difference between the cumulative wealth index as well as geometric mean. Here the 17% return is nothing but the summation of all these things. This 3.2% is the return every year you are earning from the 100 rupees. Okay. I think here is slight error. I think error is here. Okay, once again. What's the final answer? 170. You get this? Then 3.2 is nothing but compound interest over the 5 years is calculated using the geometric mean. 3.2. Okay. See? 1.032. Under compound interest, what happens? For the year 2, 3, 4, 5. Leaving 1, what is your return you are getting? 17%. Under geometric mean, what you get 3.2, you know, is the rate of actual return. Using that under compound interest rate method, you will be finally getting the same answer. So, between the cumulative as well as geometric mean is superior one. This is not so. 17% is the overall return for the 5 years. 100 becomes 117 over the 5 years period. But geometric mean says 3.2 is the return you are getting every year. If you are compounding this rate, you will be getting 17%. That's the logic here. Hope you will be now able to understand these two. Anyhow, these two are not so important for your examination, but these 3 are important. From these 3, I go further for another analysis in the next class. Okay. See you in the next class.